Welcome back, friends. I'm Deepak More, and you're watching my YouTube channel, TheIndianOptions.com. And today we are going to discuss the risk number two is that market opens gap up or gap down. Okay. Now we have identified around 14 different risks that could be that you could face when you are when you are doing options trading, and this is the risk number two, and we'll discuss all these 14 risks in 14 different videos, but this is for this video we are going to stick to only one kind of risk, that the market opens gap up or gap down. Now what does this mean, that market opens gap up or gap down? It means that, say, yesterday if the market has closed on, say, 12,000. Okay, so tomorrow the market is not going to open and start its journey from 12,000. It could start from 12,300 and above, or maybe 11,700 and below, or maybe 12,000 12,010 and above, or something. We don't know how much that gap is going to be. Sometimes the gap can be even as big as maybe 100 points, as big as the gap could be as low as 100 points. We really don't know what the issue is. Okay, now there are hundreds of reasons, but what happens is, like, when our market closed yesterday, say for example, yesterday at 3:30 the market closed, and next day at 9 o'clock in the morning, the 9:15, the market will open. Now within this time frame, there are a lot of things are happening in the world all the time, and it somehow reflects in our market conditions as well. Say for example, now when it is 2 o'clock in India, at that time the European markets open. Okay, now when the European market opens, and if there is something happening there, it starts affecting our market as well. So our market from 2 o'clock till 3:30, that is 1.5 hours, is little bit volatile, and it has some impact because of the European market. And then at night, US market opens and it closes, and then on the next day morning, Australian market opens, then Japan market opens, and then Singapore market opens, and then our market opens. Okay, now if there are so many different markets, whatever are happening in all these countries, they have smaller or bigger impact on our markets as well. So if something has happened in the world, like while we are sleeping, some bomb happened, some terrorist attack happened somewhere, our markets are going to get affected by that. Okay, now also there are some major events that might have happened within India as well, like, say, somebody, maybe the finance minister has given some positive comment or negative comment or something, then the market could go up and down, and next day it could open up and down. So like, we cannot actually understand why this market goes up and down. So it's not in our hand, it's out of our control. This, how the market is going to open, it is going to be out of our control. So all we need to do is we need to just understand that there could be a gap, and then we should tune our strategies accordingly. Okay, now in this slide, I have taken the example of 10 days from 9th of December 2019 to 20th of December 2019, and I have put up all the, when the market opened, when the market closed, and I can show you the strike that always for all these 9 days, 9 to 10 days, the market was always open above, always opened in positive as compared to yesterday, right? So first day it was like 13 points, by 13 points it opened above in the green. Then next day 11 points, next day 34 points, next day 55 points, 45 points, 29 points. So now I have purposely taken this particular example of where you have like positive trades, positive openings, like almost like 8 or 9, 10 days. Okay, because what happens is sometimes somebody might take assumption that, okay, market has gone up for last 5 sessions, the market was always up and things like that, so today market might fall. So when you are doing this kind of assumption and then trying to trade, that is a very, very wrong thing to do. Never ever underestimate the market. Never ever try to predict where the market is going to go. Now, as an option trader, when the market is happening right now, whether it's going up, down, that is when you should react to the to the market conditions. Don't react on your assumptions, or don't do any trades based on your assumption, because your assumptions are going to go wrong. Because master market works in mysterious way. That was our risk number one that we discussed. And uh, just be sure that whatever contracts you have opened today, whatever contracts are open today, and if the market opens, whatever points up or down, how it is going to affect your contracts. That is what you should be really worried about. Okay. Now, like who gets affected because of this market up and down? Okay. Now there are two kind of traders that traders actually. One type of trader is the long-term traders. Long-term traders means that they open some contract today and they can keep the contract open for several days. Okay, they can keep their contract open for several days, maybe 2 days or more. Let's say 2 days or more. Okay, and the second kind of trader is intraday trader. Intraday trader is like he opens all his contract at 9 o'clock in the morning, or whenever he feels it is a good time to enter the market, and he closes the contracts immediately before the market close, before 3:30 or before 3 o'clock or something. So he just works for the day. He's just a day worker kind of thing. Okay. So what happens is this gap up and gap down will affect, as you can understand, only for the people who are keeping their contracts overnight, and their contracts are open for the next day or third day or something. Only for those days so long-term traders or long-term trades are going to only affect by this gap up or gap down. If you are doing daily trading, then this gap up or gap down risk, it is not for you actually. Okay, so but long-term traders actually, there is again a downside and upside of this, because this is also a part of a trading behavior. We are going to have a separate session of trading behavior. There is a separate section of trading behaviors, and we'll discuss about this in more greater detail later on. But for the time being, just remember that the long-term traders tend to get more profit over a period of time, because their contracts are open for a longer period, and you get more time decay and things like that. So the earlier video we said that the time decay is our friend. In that case, it is good. This time decay is helpful for the long-term traders, because their contracts are open for a month or maybe 3 weeks, 4 weeks. So the time decay erodes and the premium goes down because of that. So it is going to help that. But for day traders, the time decay, you cannot take advantage of time decay, because there is hardly any time that is spent. The market is open for 6 hours, and all you are opening something and closing something within 6 hours. That hardly there is any movement. But so this gap up, gap down risk is not going to affect the intraday traders. And on the other hand, intraday traders won't be able to take the advantage of the time decay. So it is again the trading behavior which will help us. So just a word of caution that I want to say, that there is no fixed formula of index opening up or down. Okay, and there is no way to tell that how many points it could go up or down. It could be as well 100 points up or 200 points down. So and when this happens, like when this market opens 50 points up or 100 points up, 50 point down or 100 point down, then your open contracts will actually go haywire. Like you don't know what will happen. Like some contract, they were positive till yesterday evening, today suddenly they are in loss, or they are in a deep red, or they are in a problem. Okay, or there could be another reason. Until yesterday you were having lot of contracts, they were in negative, and suddenly because today the market opened up or down, and you are making like 50 rupees profit, or very big profit. In that situation, it's good lucky thing to have. But actually when the market opens at 9:15, you don't know how it is going to open, so you cannot predict. And when the market opens at 9:15.01 seconds, you are already late in the market. You have already the market has already gone up or down, and your options, they are already up and down. Even if you are ready at 9:15:01 to do some trading or something, it's still you are very late in the market. So you should understand that this gap up and gap down could actually affect your premiums. It could affect your contracts. So just be mindful of that, and just see how your trading behavior is going to fit, and how you can do this. And the main problem is that the stop loss you cannot set in the options. In the options, stop loss you cannot set beforehand. So you cannot set a stop loss for tomorrow today. Okay. So every day in the morning when the market opens, at that time you get a chance to set up a stop loss. So, and again, by this point of time you are already late to set up stop loss, because you have already made a loss or you have already made a profit. So again, the stop loss is not going to be able to protect us from this particular risk. So as a risk and as a word of caution, just understand that the market could go up and down any number of points any time. There is no special guarantee or any special fixed formula for this. So just understand the market could go up and down, and that could affect your premiums, or it could affect your contracts in a positive way or in a negative way. And just make sure that your trading behavior, you understand what you really want to do. And the best way to deal with this risk is always expect the unexpected. Always expect the unexpected things. Okay, take the calculated risk. There are various ways to mitigate this risk, and if you really fear that the market going up and down is going to be really a problem, then previous evening you can open some opposite trade or something, and it will cost you some money or something, but at least you can sleep peacefully. And next day when the market doesn't fall, or whatever happens, then you can just close off the hedging trade that you had done. It will cost you some small amount of money, but there are ways to mitigate this kind of up downs, and how they are going to reflect your trades. We can mitigate that. So we'll talk about that again in a lot of trading strategies, that there is a separate section in our video series for trading strategies. We'll discuss about that in that. So for this video, I think so if we can take the lesson that the market can go up and down any point, and it could affect our contracts in either positive or negative way, then that should be a good takeaway. So thank you very much for spending time with us. Thank you very much for seeing this video, and please subscribe our video, TheIndianOptions.com, and please visit our website www.TheIndianOptions.com. I'm going to upload this presentation over there, so that you should be able to download it. Thank you very much, and have a nice day.